Hey, great folks, Dorian Carter here again. So let's talk about this critical part of commercial real estate that really in the end affects your profits, and that is interest rates. How do interest rates impact commercial real estate? Just understanding how interest rate impact is like recognizing how the temperature affects a sporting event, right? So let's make it simple for you. Cost of borrowing is like the temperature of the game. Interest rates are like the temperature of the economic climate. When interest rates are low, it's if the weather is mild, it's nice, comfortable, you can enjoy the game. It's like watching a baseball game in the summer where you're not too far south, right? It's just nice and relaxing. So that's what happened. It affects the cost of borrowing. So the more expensive or the higher the interest rate, is going to be more expensive to borrow money. And guess what? You got to find that return somewhere. You got to either buy at a lower rate, you got to reduce expenses. So there is a profit to be made for investors, right? That's why we're in this game. So you have to understand that cost of borrowing is like the temperature, it goes up and down. So the nicer it is, usually lower interest rates. The more uncomfortable it is higher interest rates. So that's one. Second is the affordability of businesses. Lower interest rates mean businesses can afford to borrow more money for property purchases. That's what we want to do. We're in this for investing. And so that's why you see in the market right now, it's a little bit of difficulty now because the interest rates jumped up quick. And you're going to see some foreclosures come around. One, because commercial real estate is a business which requires that loans be refinanced sometimes 5, 7, or 10 years. And so it depends. So there are a lot of loans that were made 5 years ago, or in some cases 3 years ago, that are coming up for renewal, and that interest rate jumps up may be a problem for a lot of properties, and it's going to be a problem. And so that's why folks are really sitting on the sideline for this first quarter of 2024. But this is a measure, even if you're watching this video later on, this is very important to understand. So it affects the affordability for businesses, and so you have to look at deals and how to crunch the numbers in other locations. Increased demand for commercial real estate. You know, the fact is when interest rates are lower, people are jumping in, doing deals. Also, sellers sometimes say, okay, this is an opportunity for me to make my money or pull my money out of my deal. I made my money and now let's go invest in something else. So when borrowing is affordable, businesses are more likely to expand and invest in new spaces. Increased demand for commercial real estate is similar to fans attending the game, right? Creating a competitive market space for available spaces. So if you're an investor or you have a property and you have some vacancy there, you're going to have some competition out there of people looking to lease your spaces. And so the property values, and in turn, lower interest rate often contribute to increase in property values, right? So we can sell for more because not only are businesses doing better, their income rises, right? It's more favorable. It's a more favorable conditions for people to go out and borrow money. And so there's going to be more demand for your property, which creates competition. The value of commercial property tends to rise because businesses are willing to pay more when financing is cheaper. So just understand how that works is so important. Next is cap rates. So you want to lock into one of my other recordings that talk about cap rates and valuation and understanding how cap rate works as compared to value in property. So NOI, net operating income, cap rates are all a component of determining the value of a commercial real estate property. So you want to jump into that. That's a whole nother discussion, but it's an important discussion for just understanding how commercial real estate is valued, and it helps you understand when you hear the word cap rate, capitalization rate, and what that means is important. So it's a key metric and it's influenced by interest rates. When the interest rates are low, investors may be willing to accept a lower capitalization rate. And let me just jump in and say this. A lower capital rate means a higher value. So you see that where investors may be willing to accept a lower cap rate because with the loan, the lower interest rate, you still have the profit that you want to achieve. So when interest rates are lower, investors may accept lower capitalization rate, indicating a willingness to invest in commercial real estate for the returns. So next is refinancing opportunities. That's like the halftime. You know, some people, and it depends on your plan for investing, right? But many people get in or they find deals and they only stay in for 3 years and they jump out. So it's like halftime. Or they want to pull their money out for their investors want to get out and invest in something else because you may have acquired something. Did the value add to the property, meaning you spruced it up, made it look nice, raised rents, and now you want to pull your profits out. That's like halftime. So you refinance a property at that point, especially when you purchased a property at a higher interest rate and now there's a lower interest rate, which is going to increase the profit. So you want to pull your money out there, but you also want a cheaper cost for borrowing money. So lower interest rate create opportunities for property owners to refinance their existing loan. And it's like taking advantage shorter period than you may initially intended to stay in. And you may indeed stay in, but you want to pull your money out of it when you see an opportunity to get an lower interest rate and gain some profit earlier, right? So market dynamics. Interest rate impact the dynamics of commercial real estate property. We said this, and so we just want to hit home that these are important strategies. So when rates are low, it's like playing in favorable conditions where the game is more active with increased buying and selling activities. The market is hot when interest rates are low. So next, but it's the last one, the risk of rising rates. Changing conditions, changing weathers. The storm comes at some point. We just seen a few years where it could go from very low interest rate, everybody having a party, to now a big slowdown in investment. So the risk of rising interest rates has a direct effect. And as that rise starts to happen, that's like condition changes that increase borrowing costs, potentially slowing down the market and impacting property values. Absolutely slows people down. I know it's harder to make deals work now. I was just looking at some numbers yesterday about the cost of developing land. It's like almost double the cost it was just 5 years ago. It really, and plus you add that along with the cost of borrowing, and it's just crazy. So you got to be aware of those changing interest rates. So interest rate act as a temperature in the economic environment, influencing the affordability of borrowing, demand for commercial real estate, property values, and overall market dynamics. Just as athletes adjust their strategies based on the weather, you, as a participant in commercial real estate, must adapt to the changing interest rate conditions. I hope that helps you. Interest rates are always going to be a major piece of investing in commercial real estate. You really have to understand how that impacts a project, whether it leads to success or failure long term. You got to know it. Thanks, folks. Have a great day.